Hello, everybody. Welcome to the latest in a series of short videos that Charlie Fricker and I from Vermeer Investment Management have been shooting to try and keep investors up to date of an ever-changing market, which is continuing, I guess, to surprise people by how strongly it's performing. And of course, very inconvenient when everyone's bearish and everyone's got cash, and we ourselves have been quite cautious as well, and a little bit nervous about whether one should be chasing markets up here or actually taking money off the table. So it is quite a challenging environment, but as we promised, we're shooting a video this week that follows on from last week's inflation report. Now everyone's been crowding around the inflation data, seeing it from month to month, how much it's changing. And it's absolutely pivotal to the way markets are performing because it's framing how central banks think. So, Charlie, what do you think about last week's data and the market reaction to it?
Yeah, as you said, Tim, it was hotly awaited piece of economic data, and the markets reacted accordingly to it. I mean, expectations going into the CPI print in the US were that headline inflation would roll off a bit as energy prices have come down and gasoline prices in the States have rolled off from their elevated highs. But that core inflation was expected to tick up a bit. So those were the expectations going in. And generally, inflation came in below consensus estimates across the board, which led to the expected reaction in markets. You had yields come in on the likelihood of less central bank hiking. Equities rallied, and risk was on a general risk-on day. And although they did come in below consensus estimates, on the headline year-over-year core reading was actually unchanged on the prior month at 5.9%. Look, and whilst there's no doubt inflation coming in lower than expected is good, we want lower inflation, generally, obviously for benefited markets, but also from everyone personally in terms of how much everything's costing. But I think when you look within the data, there was elements which seem to kind of line up with the view and our view that inflation might be stickier for longer. The sticky elements of inflation specifically, I know we've referenced this a lot and talked about it a lot, being shelter, kind of OER and the rental part of CPI, which is about 1/3 of the print. They came in at about 5.8% and over 6% year over year. And those parts are stickier. So that's going to contribute to, we think, inflation kind of holding in for longer. And at the moment, the futures markets are pricing in the Fed to cut rates over the first half of 2023. But if this part of inflation starts to become stickier and maybe it levels out at about 4 rather than getting back to where the Fed wanted to be at 2, it'd be interesting. What the Fed's going to do is going to be really interesting. I don't know if you've got any thoughts on that, Tim.
Well, what was amusing last week was, as better than expected inflation data was published and stocks rallied, a number of Federal Reserve speakers were immediately rolled out to remind people that there would be no relenting and that they were going to continue with their hawkish policy of putting rates up because it was necessary to do so. And the market took one look at it and said, well, we don't care. And stocks continue to go up. So, you have got this disconnect at the moment, haven't you, between what the Fed is saying and what the market is believing, because the market clearly suggesting that at some point the Fed is going to blink and they're going to pivot to a much more soothing tone on rates and inflation. And obviously we get FOMC minutes this week, which are a bit backward looking already, but nonetheless, I'm sure they'll be closely observed, and you'd expect them to combine, just as a reminder of what Mr. Powell said at the last meeting, that they're going to continue to raise rates, but perhaps be somewhat more data dependent. And the economic news flow is mixed, but at the moment there's nothing really results season spending trends which have shifted within the US to more experiences. So the data for eating out, business results, and we'll come on talk about those in more detail in a minute at the end of our chat. But the results for their hotels were absolutely, and parks were absolutely sensational, showing no sign of economic pressure whatsoever, Whereas, of course, in other parts of the market, it is more challenging. We've had profit warnings from Walmart, and things like that, already. So there is quite a difference there. So, I think, we are in this odd moment where there is a disconnect between what the market thinks the Fed do and what the Fed are saying they are going to do. And for what it's worth, I think the truth might lie somewhere in the middle, because if we're right on the elements of inflation that are going to persist, but that economic activity is going to tail off, and don't forget the crucial part of Fed policy, that also the dual mandate that relates to employment, which at the moment is still very tight, and enabling the Fed to follow its tightening policy, because at the moment the unemployment numbers are still very low. But if that changes and the economy weakens significantly, that could lead to a change in policy. But if that is when inflation is at a persistently high level still, it just may mean that the Fed is forced to go on pause with rate hikes, but not be able to cut in 2023 for quite a considerable period of time while that resolves itself. So, it's quite boring to say, well, actually, I think rates will be unchanged, because there's no story in that. You've got to be saying, oh, rates are going to go up massively more than the market expects, or they're going to be cut. But the reality may be in the middle of that. And it remains to be seen how the economy does against that backdrop and how markets react to that, if that is indeed what happens. So central bank policy is still very unclear going forward, because it's just early in the piece in terms of how deep a recession we do or do not get. Because don't forget, at this point in time, the Federal Reserve's forecast is still that the economy will grow in 2022 and 2023, lower than it has done, but obviously that's coming off the big COVID rebound, but it's still that it will grow, and a recession can be avoided. And, we will see, and that will be quite a tough, thing to achieve. But if they do, all credit to them. But Charlie, between now and the next big piece of information we get from the Fed, we have got the Jackson Hole Symposium coming up back end of next week. And in between now and then, we do have retail results, don't we? So there is sort of another piece of the jigsaw for the Fed to utilize between now and that all-important symposium that we all watch, and actually goes into the weekend. So, what do we think about that?
Yeah, I think, as you said, this retail earnings is the stopgap event between now and Jackson Hole at the end of the month. But as we alluded to in our last video, generally earnings have been more resilient than expected and have generally been reassuring, especially with massive negative kind of sentiment going into company results. But retail earnings start this week, and as you alluded to earlier, we've already had profit warnings from Walmart, we've had profit warnings from Target. So again, I think the investor, the buy side especially, is going into these results very, very cautiously, with the backdrop of what the consumer has been saying. Consumer confidence, although it's bounced recently, is still weak. We've had warnings from a lot of companies. So I think the more important, rather than what the results actually are, I think the more important thing to be looking out for is, what are these companies guiding to, if they guide at all? What are they seeing on the ground right now in terms of what the consumer is doing? Are we seeing accelerated trends from what they call out within the profit warnings in terms of slowing spending, trading down within categories? Are those continuing or accelerating, or have they even improved? Who knows? So I think that's the real thing that people are going to be watching out for. On the headlines basis, with the big retailers, Home Depot reports this week they had a really resilient set of results 3 months ago. So what are they saying about home improvement, given how quickly the housing market's rolled over in the US? So all those dynamics are going to be really interesting things to keep an eye on. But as you alluded to earlier, in terms of consumer spending, Disney had a really, really good set of results last week that seemed to indicate, for experiences and products and stuff that people want to go to, consumers still willing to pay. They're willing to travel and willing to go out and spend on experiences, and what ended up being a very, very good set of numbers for Disney, wasn't it?
Yeah, so it's very interesting in Disney, isn't it? Because although the stocks had a nice little run since its results and recovered with the market, it's actually had a very difficult period, brief moment in the sun when during COVID they launched the streaming business, and the stock did really well because streaming numbers were sensational because everyone was stuck at home. But it's been pretty hard work since then. So it was very interesting to see that an activist investor has come into the stock this week with a whole bunch of recommendations as to how value can be accreted in Disney. And, I'm not actually potentially think it's a necessary comment on their suggestions, but what I do think is really interesting, and something that we highlighted before, is, as a franchise, I do think Disney is very undervalued. The content that it owns, tends to get forgotten about when things are difficult. But actually, the reason they're still doing well in streaming, I believe, and other companies are struggling, is they've got great content. And, just remind ourselves, Charlie, they bought Pixar, Lucasfilms, and Marvel some time ago now. And, what do you think might cost someone if they decided that they wanted to own those franchises now? We are talking telephone numbers relative to, to what Disney actually paid for those businesses, aren't we?
Yeah, I think they collectively paid under $20 billion for those three franchises. And the only thing I can say for certain right now is that you could argue that Marvel alone would be worth well more than 20 billion in total, given how well they've that content platform has performed. And I think you're right. I think one thing that over the last 6 months or so, since Netflix's warning back in January, has really brought back into focus is this idea about quality over quantity. And I think they're having these franchises, having the right content base that they can then extrapolate from, I think is all important. There's really investors are honing back in on that. I think it's not just about how much money you can spend, it's about what you're spending that on. And I think Disney's thinking about that reasonably sensibly. And in Europe, with the Hulu content onto the Star tab over in Europe, it's a separate product in the US with Hulu. But I think it sets them up pretty well. And their subscriber base, let's not forget, as an aggregate across all their streaming platforms, is give or take where Netflix is right now in terms of total streaming subs. So they've caught them up very, very quickly. And I don't necessarily think they're getting the credit for how quickly and how well they've built up that business, whilst the parks continue to be all guns blazing.
Yeah, I mean, Parks has just proved itself to be a phenomenal franchise, and of course, it's not a surprise to me that the consumer who wants to go and do some of the things it hasn't been able to do during COVID is going straight back to that. And although that may be facing some quite difficult comparisons next year, don't forget, China's still closed. Cruise business is still just getting going, having been completely closed down as well. So, and Disney's continued to invest in that. So, it's a great flywheel, isn't it? Of you create great content that drives people to the parks, it drives people to buy merchandise, it drives people to TV shows, it drives people onto the content platform. And, that is a flywheel, I think, that's been underestimated by markets for some time. So it's really interesting to me that an activist investor is now urging change, just as the company has been through a very, very difficult time. Management's been under serious pressure. Share price has been very poor, and I think that's is a very interesting scenario going forward. Anyway, let's leave it there. There will be lots for us to comment on again in the future. My guess is that we'll be back on post the Jackson Hole Symposium, if there's been something very interesting to talk about there. Plus, we'll have got through the retail results, so that's an opportunity for us to come back and talk a little bit again about how we're seeing things. Just as a quick reminder, Vermeer runs a long-only global equities fund, just over £50 million in value, runs just under 60 stock names. We've been doing this for over 5 years now. And we look forward to keeping you updated with our thoughts going forward. So thanks very much for your time today from both Charlie and I. Thank you.